Hi, Tommy Lim here from SF Capital, and welcome back to our Finance Mythbusters series, where we answer common questions business owners face when getting a loan. Today, we're going to be looking at the myth, my business made a loss, I can't get a loan. Have you ever recorded a loss on your business's profit and loss statement and thought to yourself, my bank is going to hate this. How am I going to get a loan? Perhaps this was intentional to lower your taxes for that year. Maybe you even felt like you had a great year, and that's why you used extra money to upgrade your warehouse, purchase a new motor vehicle, or even try that expensive marketing campaign. Well, generating a loss in your financial statements doesn't automatically mean you can't get a loan. This is because an accounting loss is different to the underlying cash flow that your business might be generating that can be applied to loan servicing. That is, a paper loss is not necessarily the same as the true income that your business is earning. This is really important so that you don't rule yourself out too quickly from applying for a loan, and instead seek help to analyze your financials and present them in the right way to a bank. So, what figures is the bank looking for? When trying to determine if you can afford a loan, the bank is trying to identify the income that represents your recurring surplus cash flow that can be used to maintain interest or pay down debt. This is otherwise known as your normalized earnings or simply your servicing income. And to get to this figure, we need to apply what banks call add-backs to an accounting loss. To understand how add-backs work, let's go through an example. Imagine the following profit and loss statement. Sales of $800,000, gross profit of $500,000, and your net profit before tax is negative $20,000 due to operating expenses being higher than your gross profit. Let's also assume for simplicity, this business has no debt and thus no interest expense. In the context of this profit and loss statement, an add-back is any business expense that is added to the net profit before tax to derive your underlying cash flow for loan servicing. Let's look at 3 examples. The first is director's salary. As the owner of the business, you decide how much to pay yourself, and this money is paid directly from the business to you, so remains within your control even though it has left the business as an expense. Because of these elements of discretion and control, a bank lets you add back your director's salary and apply it to loan servicing. The second add-back is depreciation. This add-back relies on a bit of accounting knowledge. Due to accrual accounting rules and the matching principle, expenses should only be recognized in the same period that corresponding revenue is generated. For example, you might pay for a piece of equipment today, but will only realize the benefits of that equipment over many years. Depreciation is an expense that allocates the cost of that equipment over many years as the asset is being used up. However, because you already paid for that piece of equipment in the past, there isn't any cash being used when you recognize the depreciation expense each year. It's the non-cash nature of this expense that makes depreciation an add-back when calculating your servicing income. The third add-back is one-off expenses. These are usually large, non-recurring expenses that are not typical in the normal operations of your business. Examples of these are large renovations or fit-outs, large asset purchases, new business setup costs, specialized recruitment, or even education expenses to upskill and reskill. These expenses are added back to an accounting loss because they have temporarily reduced your earnings but are not part of your business's normal cost structure. So, revisiting our example, let's say we have net profit before tax of minus $20,000, but we look deeper into operating expenses and we find 1. Director's salary of $120,000, 2. Depreciation of $30,000, 3. A one-off upgrade to existing premises of $100,000. In this case, your income rises from the minus $20,000 you thought the bank would first use to $230,000, which is a much higher figure. And hopefully, this gets you somewhere meaningful in your borrowing goals. I hope this video has helped break the myth, my business made a loss, I can't get a loan. If you have any questions, feel free to drop them in the comments below, and I look forward to seeing you in the next episode of Finance Mythbusters.